Have you ever dreamed of making life-changing investments?
Have you?
We all have. The thing is, though, while we all have our sights set on making mad gains, not many people have actually managed to achieve that dream. Some people have, though, and this begs the question of who are the most successful investors. Well, today we'll tell you about the top 5 investors in the world, how they make consistent returns, and how you can learn from their success. Stay tuned. Before we begin, it's important to know that I'm not a financial advisor and nothing you're about to see is financial or investment advice. This video is purely for entertainment and educational purposes. Okay, with that said, let's begin with a bit of context about today's list of successful investors. So the investors today are ranked on their ability to make consistent returns on their investments. In other words, we've ranked these guys on their average annual investment returns rather than the amount of money they've made or their personal net worths. But why is this? Well, consider the following. Imagine you have $1,000 and you invest it into a stock that suddenly rallies by 10x. Does this mean you're a successful investor? Well, in part, yes, because you've made substantial gains. But could you then do it repeatedly, making enough money to earn a living? How much research did you do before investing? And how much of those gains were based on luck? It goes without saying that unless you really did your homework, it's unlikely that you'd be able to replicate this and call it an investment strategy. Sure, you could try, but the chances of you consistently repeating that same scenario would be slim. But there are some who have mastered the craft of doing their own research, and these are the guys who can make consistent returns that others can only dream of. Now, we've ranked these investors in reverse order just for fun, but we'd encourage you to watch the whole way through. That way, you'll get a good sense of how each investor made their fortune and how you could implement their ideas into your own investment strategy. So, with that out of the way, let's dig in, shall we? Okay, in 5th place today is Bill Ackman, whose investment approach has earned him an average of 17% annually, beating the S&P 500 average by around 7 percentage points. Bill is the founder and CEO of Pershing Square Capital Management, a hedge fund company based in New York. He earned a Bachelor of Arts degree in history from Harvard College and got a Master's in Business Administration from Harvard Business School. So, pretty much your typical billionaire upbringing. Bill has a net worth of $9.1 billion, putting him just outside the top 300 richest people in the world. Whew, that must sting. Now, Bill is known for being an activist investor and is a controversial figure. For context, an activist investor is someone who buys a significant amount of stake in a company to advise, or even force, certain business decisions. Bill has a somewhat unique investment approach, which includes analyzing a company's value, selecting just a small handful of easy-to-understand companies to invest in, and avoiding over-diversification. He also ignores short-term volatility, instead focusing on investing long-term, looking for potential catalysts that could cause a stock's price to rally. Bill's activist investor approach has resulted in some big wins. One of his earliest as the CEO of Pershing was buying a large stake in Wendy's burger chain and pressuring its management to spin off its Tim Hortons chain. Bill would later exit his Wendy's position at a considerable profit, despite Wendy's stock underperforming. Tim Hortons would then later merge with Burger King, which incidentally Bill also had a significant stake in. He really made a whopper of a move there. Sorry, not sorry. Anyway. Prior to Pershing, Bill had had success in shorting the Municipal Bond Insurance Association, or MBIA, after noticing that something wasn't quite right. He believed the mortgage loans being offered were riskier than people realized and that the whole business was built on bad debt. So, he bought insurance that would make him money if the company went under and bet against the company's stock. 5 years later, Bill's bet would pay off as the company's stock and credit rating crashed in the 2008 financial crisis. However, perhaps Bill's biggest success was when Pershing invested in a failing mall operator called General Growth Properties. Pershing invested $60 million into the business and would later exit its position with a return of $1.6 billion, roughly 26x the initial investment, making it one of the most successful hedge fund trades in history. Bill has had a number of failed investments too, including Target Corporation, Borders Group, and Herbalife Limited. The most infamous failure, though, was Pershing's investment in Valeant Pharmaceuticals International, where its 8.5% stake in the company resulted in a loss of over $3 billion. Well, you can't win them all. And by the way, if you're enjoying the video so far, give it a boost by investing in those like and subscribe buttons. And don't forget to turn on those notifications too, so YouTube gives you dividends in the form of more sweet, sweet video content. Okay, in fourth place is the name you'll likely recognize most, Warren Buffett. Now, you might be wondering why Warren didn't make it further up this list. After all, he's arguably the most prolific investor of all time, with a staggering net worth of over $145 billion, making him the sixth richest person in the world. So, what gives? Well, despite decades of investment success, Warren's average annual return is around 20%. And recall, that's the measure we're using for today's video. Anyway, Warren earned a degree in business administration from the University of Nebraska. After being rejected from Harvard, he earned a master's degree in economics at the Columbia Business School, where he was taught by his future mentor, Benjamin Graham. As you might already know, Warren has been the CEO of Berkshire Hathaway since taking it over as a failing textiles company in 1970 before reshaping it into one of the biggest conglomerates in the world. And this is where most of Warren's massive wealth comes from. For context, Warren originally bought shares of the company back in 1962 for $7.50 a pop. At the time of shooting, Berkshire's share price is over $692,000 per share, earning him an insane return of almost 100,000x. Now, Warren is known for being the most prolific value investor in modern history. A value investment strategy involves doing a detailed analysis of a company's strengths in order to determine its intrinsic value. If a company is deemed undervalued, a value investor will buy up shares of the company and then simply wait. Now, this is easier said than done, but it's a skill Warren has mastered over the years and is why he's known as the Oracle of Omaha. Warren has an uncanny ability to pick the very best companies to invest in. A classic example is Coca-Cola, which he invested in after realizing it had the most recognizable brand and a business that was destined for growth in the coming years. Warren started buying up shares in 1987, building up a 6.2% stake in the company for around $1.3 billion. Today, that position is worth around $25 billion, and as a fun fact, Berkshire received $736 million in dividends. Basically, passive income. Another successful investment was American Express. Warren started buying up shares in 1964 and continued after joining Berkshire for a total of around $1.3 billion. Today, that's worth over $34 billion. A great result, providing you're happy to wait 60 years. Now, of course, nobody gets it right every time, and Warren Buffett is no exception. In fact, one of Warren's biggest misses was, ironically, with Berkshire Hathaway, back when it was a failing textiles company. Warren bought a boatload of shares simply because they were cheap, but the textiles industry was taking a beating. He wasted more money trying to save the business from going under, even burning through company profits. He was then forced to restructure the company into what it is today.
Hello, it's me, Guy's cousin Barry. I'm very sorry to be interrupting this no doubt fascinating video, but I want to tell you about the Coin Bureau deals page, so listen up and listen well. Alright, this is the place where you will find all the amazing promos and discounts what you, as Coin Bureau viewers, are entitled to. So don't be a mug, go and check it out using the link below. You'll find discounts on hardware wallets, you'll find exchange sign-up bonuses, some of which are absolutely bleeding mental, and you will find trading fee discounts there as well as a whole load of other goodies too. And let me tell you, old Barrington here, he's had to hammer the dog and bone all bleeding day and night to get you these promos and discounts. So you're welcome, thank you very much, go and have a look pronto, or I'll have to come and have a word. Alright?
Okay. In third place today is well-known investor Peter Lynch, whose investment approach has seen him achieve an annual average return of 29%. Peter is a hedge fund manager best known for running Fidelity's Magellan Fund, an actively managed mutual fund between 1977 and 1990. For context, the Magellan Fund is one of Fidelity's most popular funds, primarily investing in US domestic large businesses. Under Peter's management, the Magellan Fund grew from $20 million when he took over in 1977 to $14 billion by 1990. That is some serious growth. Peter studied history, psychology, and philosophy at Boston College before earning an MBA from the Wharton School at the University of Pennsylvania in 1968. He retired in 1990 at 46 years old, with a smaller net worth than anyone else on this list, but that's not to say it was a small amount of money. I mean, I'm sure none of you would grumble if you had $450 million when you retired. Am I right? Now, Peter's investment style is fairly straightforward. At heart, he's a value investor, but his most famous principle is to only invest in what you know and do as much due diligence as possible. Peter famously grew the Magellan Fund through its investments in huge companies like Ford, Taco Bell, Dunkin Donuts, and General Electric. Reportedly, many of these investments would go on to grow by more than 10x the initial investment, although it's not publicly known how much was invested and how much money was actually made. Peter also has some regrets, the most notable of which was not investing in Apple stock. In his own words, quote, "Apple was not that hard to understand. I mean, how dumb was I?" Well, Peter, you retired early with almost $500 million in the bank, so not that dumb, really. Now, in second place on today's list is George Soros, a legendary hedge fund manager. George is widely believed to be one of the most successful investors of all time, with an average annual return of 30% on investments between 1970 and 2000, triple the S&P 500. As a young boy, George left Hungary in 1947 when he was just 17, after it had been occupied by Germany in the Second World War. He moved to England, where he attended the London School of Economics, earning a Bachelor of Science and a master's degree in philosophy. George then later created his own hedge fund called Soros Fund Management in 1970, where he remains chairman. His incredible investing history has earned him a net worth of $7.2 billion. Now, George's investment style is slightly different to that of most billionaire investors. That's because, although George does the due diligence necessary to make key investment decisions, a lot of his investments revolve around instinct. In other words, George listens to his gut. In fact, George listens to his entire body because he's even made investment decisions based on things like backache. Sure, this sounds absolutely crazy, but George is the billionaire here, so, well, who are we to argue? Kind of makes you wonder how many people have missed out on mad gains after visiting their chiropractor. Anyway, George does also use more conventional methods elsewhere. He uses market feedback to predict potential bubbles and opportunities. He also creates a forecast for what he believes will happen in the market and tests his theories with small investments before going all in once he's satisfied. He also uses a small handful of advisors to make big investment decisions, taking the time to consider any potential issues they might raise. In his time at Soros Fund Management, George has made some massive profits, both in the stock market and in forex trading. His most famous trade by far was when he shorted the British pound in 1992, after the UK government announced plans to hike interest rates. George believed this wouldn't be enough to prop up the pound, and placed a $10 billion bet against the Bank of England. George was proven right and famously earned $1 billion in a single day. This has been labelled as one of the greatest currency trades in history. But the day was so infamous that it was named Black Wednesday, with George being named as the man who broke the Bank of England. Like all investors, though, George has made a few mistakes along the way too. The most notable hit he took was his investment in Bear Stearns stock when he paid $54 per share. Just a few days later, those same shares were sold to JP Morgan for just $2 a share at a loss of over 96%. What's crazy, though, is that George is incredibly humble about his losses. He famously said that he's only rich because he knows when he's wrong, and says that recognizing mistakes is a source of pride. In his words, quote, "There's no shame in being wrong, only in failing to correct our mistakes." Wise words indeed. Okay, folks, the moment you've all been waiting for. The investor taking the crown in today's list is Jim Simons, who was a hedge fund manager, investor, and mathematician who sadly passed away. Jim's investment success is unparalleled at a whopping 39% average return per year, almost 4 times higher than the S&P 500. What's even crazier is that Jim was able to achieve a mind-melting annual return of 66% on average before subtracting fees. Now, Jim's education centered around mathematics. He earned a bachelor's degree at the University of California and went on to teach the subject at Harvard. Not only did this give Jim a stellar teaching career, but it also came in handy when he created his own hedge fund called Monometrics, which was later rebranded to Renaissance Technologies. Jim served as the chair and CEO of Renaissance Technologies until he retired in 2010. At the time of his death, his net worth was a staggering $31.4 billion. Renaissance Technologies was famous for its medallion fund, where Jim used his maths wizardry to create a unique quantitative trading strategy that only his team were ever allowed to know. What we do know, though, is that his quantitative approach relies on complex models and algorithms to analyze massive amounts of data to identify patterns and anomalies in the market. Jim also used a team of mathematicians and physicists for high-frequency trades, which usually involve placing massive trades at lightning-fast speeds. These trades took advantage of arbitrage opportunities and would often trade with leverage to maximize gains. Now, as with everyone else on this list, Jim has had his fair share of hits and misses, although it should be noted that between 1989 and 2005, the only year his medallion fund experienced a loss was in 1989. Some of Jim's most notable wins include an investment of $67,000 in Soleno Therapeutics, which would grow by over 3,700% to over $2.5 million. Jim also invested around $3.3 million in Camtech Limited, an investment which would turn into over $46 million. He also turned a $23 million investment in Corvell into $167 million and a $9 million investment in UFP Technologies into $57 million. And although Jim experienced minimal losses over the years, there were a few mistakes made along the way, particularly in the early days. In its first year of operation, the Medallion Fund saw a return of just 9%, massively underperforming the S&P 500, which had gained 16% by comparison. In its second year, the Medallion Fund actually made a loss of 4%, whereas the S&P rallied by 30%. Renaissance Technologies' Medallion Fund also took a notable 20% hit in August 2007, along with other quantitative hedge funds. This 20% hit resulted in a loss of over $1 billion in a single week. Other larger funds suffered a smaller percentage hit of 10%, but due to their size, saw a loss of over $3 billion. These losses were so bad that Jim worried his company wouldn't survive, and he ended up intervening directly by reducing positions, despite his advisors suggesting otherwise. Other than these few hiccups, though, Jim's investments were overwhelmingly successful, and although he's sadly no longer with us, he'll go down in the history books as one of the best investors that ever lived, albeit unknown to many. So then, what lessons can we learn from this incredibly successful bunch? Well, the first and most obvious lesson is that research is key. Every successful investor, even outside of this list, spent their time doing the due diligence necessary to make an informed investment decision. So, lesson number 1, do your own research. And this relates to lesson number 2, take your time. Most successful investors will take a breather between researching a company and laying down an initial investment. This is for several reasons. First, it helps avoid the risk that you're investing based on emotion. A great investor knows to trust their head more than their heart, apart from George Soros, who literally listened to his heart. But let's not overcomplicate things. Now, second, it helps to identify key entry points rather than FOMOing in at the earliest opportunity. Lesson 3 would be to pay attention to the narrative. As you'll have noticed, many of the companies invested in were the best in their leagues, and that's because they had the highest chance of success in their respective fields. Sure, you can make faster gains with smaller companies, but that carries additional risks that could result in significant losses in the long run. And this ties into our fourth and final lesson: be patient. Remember, it's a marathon, not a sprint. Most successful investments make their considerable profits after a number of years, and Warren Buffett is probably the best person to look at if you need evidence of this. Like many investors, Warren knows that if a company will grow in the long haul, then the short-term price action is almost irrelevant. Although it's always good to keep an eye out for significant price dips along the way, because these could present fantastic buying opportunities. Not financial advice, of course. Okay, and that is just about all for today's video, folks. So if you enjoyed it, smash those like and subscribe buttons and turn on those notifications. If you know someone this video could help, take a second to share it with them. Thank you all so much for investing your time into watching this video, and we'll see you in the next one. This is Guy, over and out.